Muthoot Finance just hit historic highs in Q3 FY26, and the numbers are absolutely explosive for the intelligent investor. We're looking at a massive milestone as their assets under management officially crossed the 1.5 trillion mark, fueled by a staggering 103% surge in profit. Breaking down the core financials, the consolidated profit after tax reached 2,824 crore, representing that 100+% year-on-year growth. Even more impressive is the asset quality, where the gross non-performing assets dropped drastically from 4.22% down to just 1.58%. The scale of operation is now at 1,64,720 crore. When we look at the gold loan growth specifically, it's up 50% year-on-year, and that core gold business now makes up 88% of their entire consolidated portfolio. Volume is clearly king here. How did profit grow twice as fast as revenue? That is operational leverage in action. While revenue grew 58%, profit before tax soared by over 100%. This happened because the company slashed impairment costs by 49% and benefited from massive economies of scale. The foundation here is incredibly secure because the fortress is literally built on gold. 88% of all consolidated assets are gold loans. We're talking about 205 tons of physical gold holdings acting as collateral. The business remains laser-focused on this secured lending model to maintain its edge. The company is squeezing way more value out of every single location. Branch productivity is up 47% year-on-year, with the average gold loan per branch jumping to over 28 crore. They also added 1.31 million new customers in just the last 9 months, proving the infrastructure is driving higher margins. There is hidden value in the subsidiaries that used to be a drag on earnings. Muthoot Money has officially turned around, moving from a loss last year to a 203 crore profit this year. With AUM growth at 168% and Belstar Microfinance contributing 51 crore in quarterly profit, diversification is finally paying off. Now let's talk about the risk shield. This is one of the cleanest books we've seen in recent history. Gross NPA has plummeted from 4.22% last year to just 1.58% today. Because the books are so clean, they've been able to slash impairment provisions to just over 1% of loan assets. But it isn't all perfect. Growth has a cost. We are seeing some margin compression as net interest margins, or NIM, dropped from 12.77% down to 11.6%. Borrowing costs are rising 53% year-on-year, which is faster than their yields. This is the #1 metric to watch next quarter. Even with those pressures, the balance sheet is a fortress. Net worth stands at over 35,000 crore with a debt-to-equity ratio of 3.9. Their capital adequacy ratio is at 20%, which is well above the 15% regulatory requirement. This gives them plenty of headroom to keep growing. So, is 17 times earnings cheap for a company growing this fast? At 17.89 times trailing PE and 4.4 times book value, the market is definitely charging a premium. However, that premium is backed by an elite return on equity of over 28%. As an investor, you have to know the risks. First, rising interest rates could squeeze those margins even further. Second, their status as an upper-layer NBFC means much stricter regulatory scrutiny. Finally, the business is always sensitive to fluctuations in gold prices, which affect their loan-to-value ratios. The bull case is built on historic 51% growth, a massive cleanup in asset quality, and a successful subsidiary turnaround. The bear case is the margin compression and the high 4.4 times book valuation. Our verdict? Constructive. The sheer volume of growth currently outweighs the pressure on margins. The final takeaway is clear. Muthoot has successfully shifted from a steady compounder into a high-growth engine. The 51% growth is undeniable. The only real question left on an otherwise flawless report is whether they can stabilize those interest margins in the coming months. If you found this earnings deep dive into Muthoot Finance helpful, make sure to like, save, and share this video. Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.